When a neighbor falters, a wise nation listens. Bangladesh, once celebrated as South Asia's quiet success story, now finds itself navigating its most fragile economic moment in decades. This is a nation that turned garments into growth and microfinance into a movement. But today, the fabric is fraying. Non-performing loans have surged to nearly 4.2 lakh crore taka, about 36% of the total sector credit. Non-bank financial institutions are under intense stress, with 1 in every 3 loans now in default. A model that once combined export dynamism with financial innovation is now struggling with liquidity, credibility, and confidence. The 3 cornerstones of any modern economy. In June 2025, the International Monetary Fund (IMF) approved 1.3 billion US dollars in additional assistance to Bangladesh under 3 facilities: the Extended Credit Facility, the Extended Fund Facility, and the Resilience and Sustainability Facility. This support came on top of the already $4.7 billion program approved in 2023, marking one of the largest IMF engagements in South Asia in recent years. The IMF's aim was to stabilize reserves, restore fiscal credibility, and anchor structural reform. And in the short term, it worked. Reserves that had slipped below $20 billion in 2023 recovered to around $27 billion by mid-2024. The taka stabilized, inflation eased modestly, and exporters began to breathe again. But as every economist will tell you, IMF buys time, not transformation. Liquidity is a bridge, not a cure. It can stabilize the balance sheet, but it cannot rebuild the moral spine of finance. Because when financial discipline erodes and politics infiltrates credit decisions, money ceases to measure value, it merely mirrors power. For India, Bangladesh's crisis is not a spectacle, it is a signal, a warning of what happens when institutions lag behind ambition. It reminds us that growth without governance is a high-speed journey without brakes. The health of finance ultimately determines the horizon of growth. And when the scaffolding of regulation weakens, even the most elegant architecture of GDP eventually cracks. Bangladesh's turmoil was not sudden, it was structural. Years of deferred recognition, restructuring instead of recovery, leniency instead of law allowed bad debt to metastasize. When the very term willful defaulter was proposed for deletion from banking law, the line between policy and patronage blurred. The result was predictable: a banking system that funds connections, not competitiveness. And once trust collapses, trade follows. Exporters lose working capital, factories slow down, and a liquidity problem becomes a livelihood crisis. India must read this moment clearly. Financial systems don't fail from lack of money. They fail from lack of discipline. And discipline in finance is institutional, not emotional. To India's credit, we have been here before. The twin balance sheet crisis of the 2010, when over-leveraged corporates and overextended banks strained simultaneously and forced a difficult reckoning. Reforms followed. The Insolvency and Bankruptcy Code reintroduced accountability, provisioning norms were tightened, and public sector banks were recapitalized and cleaned. Those were hard choices, but they restored prudence. Yet, success can dull vigilance. As India scales up manufacturing, infrastructure, and credit expansion under schemes like PLI and Make in India, the temptation to blur prudence for growth must not resurface. The lesson from Dhaka is very clear. Growth is not dangerous, but unregulated optimism is. Bangladesh's experience reveals a deeper truth. Trade depends on trust and trust depends on finance. When the financial arteries clog, even the most productive exporters suffocate. India's manufacturing surge could hit a similar bottleneck if credit access remains uneven or opaque. We celebrate ports, highways, and free trade agreements, the visible infrastructure. But now we must also build the invisible one, a financial ecosystem that moves capital as efficiently as we move containers. By 2027, India can integrate GST data, e-invoicing, and export receipts into a unified trade credit platform. By 2030, every small enterprise from Tirupur to Moradabad should have a verified digital credit identity as credible as a corporate balance sheet. That is how you democratize credit, not by waiving loans, but by widening access. At its core, Bangladesh's crisis is not fiscal, it's institutional. The IMF's conditionalities reflect this truth. Greater exchange rate flexibility, stronger tax compliance, and tighter financial supervision. These are not mere technocratic fixes, they are moral signals. India must see its own institutions, the RBI, SEBI, and IBBI, as strategic assets, not bureaucratic entities. Their autonomy is not a privilege, it is a national safeguard. It's what keeps investor confidence steady when politics turns unpredictable. And vigilance must extend to our shadow banking sector. The NBFCs remain vital for MSME and rural liquidity, but their growth must not outpace their governance. Dhaka's NBFIs became conduits of crony credit. India's must remain conduits of credible capital. Embedding stress testing, transparency, and climate linked risk analytics into every lender's DNA is not over-regulation, it's prevention. A crisis in one South Asian economy weakens the credibility of all. Financial contagion travels through trade routes, remittances, and investor perception. India, as the region's largest economy, must take the lead in building regional financial resilience. A South Asia Stability Forum led by India with the World Bank and IMF could institutionalize cooperation, sharing expertise in banking regulation, fintech, interoperability, and export credit insurance. Leadership in economics begins not with rhetoric, but with architecture. Bangladesh's reforms may restore calm for now, but the real test lies in whether institutions can rebuild faster than liabilities grow. For India, resilience must be proactive, not reactive. By 2030, our ambition should go beyond a $5 trillion economy to create a crisis-proof financial ecosystem, digitally integrated, one that is climate aligned and analytically agile. An India where regulators use AI to detect stress early, where credit flows seamlessly across sectors and borders, and where the digital rupee interoperates with regional currencies. That is how India graduates from stability to strategic agility. Bangladesh's predicament is not a failure of ambition, it is a failure of accountability. For India, the task is to turn that caution into capability. Because our destiny will not be defined by whether crises occur, but by how well prepared our institutions already are when they do. A crisis-proof India will not emerge from liquidity or luck. It will emerge from leadership and from the quiet daily discipline of strong institutions that never stop learning. That is how India turns its neighbour's warning into its own wisdom and builds not just fast growth but resilient, intelligent growth. That is the true lesson from Dhaka.